When we delegate financial investment to intermediaries, we do so to facilitate risk sharing and maturity transformation. And importantly, we delegate the screening and monitoring of the ultimate user of our funds, potentially reducing adverse selection and moral hazard problems. However, in practice, we do not trust financial intermediaries alone to fulfill this function without government regulation and supervision. There really are few private markets that are as heavily regulated as the financial system. For instance, the Dodd-Frank bill passed by Congress in 2010 is a 2,300 pages long, arguably comprehensive, really one of the most comprehensive US laws that was ever passed. The law itself is open-ended in many ways, since lawmakers are not necessarily experts on finance, giving substantial leeways to existing regulators like the Fed or the Office of the Comptroller of the Currency to add their own regulatory standards. It adds to a large body of existing regulatory rules and establishes a new regulator in the Office of the Consumer Financial Protection Bureau, targeted at consumer lending in particular. Financial intermediaries and banks, especially, have extensive reporting requirements and are subject to regulatory supervision. Even though intermediaries can help reducing asymmetric information problems, they cannot fully remove all informational asymmetries themselves. Instead, in, say, a lending transaction, for example, a bank splits the original information asymmetry into two, one between the borrower and the bank, but now also between the bank and its own external and internal investors. For instance, once you deposit your paycheck with your bank, it will use those funds to make investment decisions. You do not have perfect information into which bank makes better portfolio decisions than others, and you cannot perfectly observe how a bank uses your funds. Adverse selection and moral hazard problems in banking hence continue to exist. The regulatory framework of the past 10 years has transformed dramatically in response to the 2008 housing crisis, which was at core a bank crisis and at the time the biggest downturn since the 1930s. Banking crises in general are worse than most other financial crises, since the banking sector is both critical in extending funds to virtually all corners of the economy and is also at the same time the piggy bank for households and much of corporate wealth. Before the previous recession, housing prices had been bid up throughout much of the early 2000s through questionable lending practices, and when the market then turned after 2007, losses spilled back onto the banking sector's balance sheet, and from there pretty much into every corner of the economy. Generally speaking, a bank will go out of business if it is insolvent. Insolvency is technically defined as a scenario in which the value of a firm's liability, everything the firm owes, exceeds that of its assets. In this scenario, even if a firm sold all of its assets, it wouldn't be able to pay off all its debtors. Typically, this goes hand in hand with a preceding deterioration in assets. In the 2008 crisis for banks, those were mortgages and related mortgage-backed securities, which quickly lost in value after the market turned in 2007. What exacerbates this problem in the case of banks is a phenomenon referred to as financial contagion. This refers to so-called liquidity crises, which are slightly different from insolvency. Because banks have very liquid liabilities, mostly in the form of deposits, which can be withdrawn quickly, and at the same time have very illiquid assets like loans, which often mature after many years, a quick withdrawal of a lot of liabilities at the same time can cause a bank to run out of cash to meet those withdrawals. This is sometimes referred to as a bank run, the image being depositors rushing the bank and withdrawing from the deposits. And it can cause a bank to go out of business as well, even if the bank itself is solvent. Typically, for reasons that should be fairly obvious, we would like to have only insolvent banks go into bankruptcy. Firms that have assets that are worth more than liabilities are typically sound firms. But in a typical financial crisis, it can be difficult to tell for investors which banks are insolvent and which are simply illiquid. Now, if depositors or other short-term lenders suspect that their bank is insolvent, they may rush to withdraw their funding from a bank, therefore bankrupting the bank in a kind of self-fulfilling prophecy, even if the bank is actually solvent. Nowadays, for reasons that we'll discuss, this is typically not happening through depositors withdrawing, but through other short-term lenders, but it is still a common problem in banking crisis overall. Now, due to financial intermediaries' macroeconomic relevance, and because of the possibility of contagion, pretty much any government protects financial intermediaries throughout what is called the government safety net. The most basic tool to prevent bank runs is so-called deposit insurance, which protects depositors' funds up to a certain amount. If you know your deposits are safe, it simply shouldn't matter to you that you think your bank is going bankrupt or not, because your funds are insured either way. Deposit insurance therefore reduces the risk of these self-fulfilling prophecy type bank runs. However, with the risk of a bank run removed, depositors also have less incentive to monitor the bank behavior in the first place. That in return increases incentives towards moral hazard on behalf of the bank, like risk-taking or, for instance, even fraud. In the United States, deposit insurance is provided by the Federal Deposit Insurance Corporation, the so-called FDIC, which assumed operations after the banking crises of the Great Depression from 1929 to 1933. During these 4 years, about 2,000 banks failed every year. After the establishment of the FDIC, the incidence of bank failures in the US was drastically reduced to a handful. The FDIC operates an emergency fund which collects contributions from commercial banks to pay out for insolvencies. And the FDIC will then typically try to assume an insolvent or liquid bank and sell it to another bank, ideally thereby protecting all assets. Because deposit insurance removes incentives for depositors to monitor what a bank is doing, funds are protected only up to $250,000 per bank, not per deposit. The idea here is that large-scale depositors should have the ability and resources to monitor bank behavior. Unfortunately, in practice, this is really enforced for large banks, which since the 1980s are considered too big to fail by regulators. That means that if a bank is of macroeconomic relevance, it effectively has a bailout guarantee even beyond just those $250,000. Every now and then, when banks are threatened by bankruptcy, the FDIC will bail out even bondholders. More recent example are banks like Citigroup that effectively went bankrupt during the crisis 10 years ago, which were then recapitalized with the help of the Federal Reserve and the Treasury. The largest bank which was allowed to fail during the financial crisis was Washington Mutual. At an asset size of about $33 billion at the time, it accounted for less than 1% of total assets of the US banking sector, so it really wasn't a very large bank by that standard. Central banks are another component of the government safety net. They're often referred to as lender of last resort because they can lend when nobody else can or will, simply because they can generate liquidity through the money creation process. The Fed has a standard channel for emergency lending to individual banks, which is the so-called discount window operated by the New York City Federal Reserve District Bank. If banks have difficulties meeting the reserve requirements and cannot borrow elsewhere, the Fed may extend a discount loan in exchange for high-quality collateral. Such loans are typically overnight, short-term loans extended at the so-called discount rate, which is directly set by the Fed. In normal times, the Fed discourages the use of the discount window, publishing its users and charging interest rates above interbanking rates like the federal funds rate. However, the Fed has in crisis times encouraged the use of the discount window, dropping such obstacles, and for instance has extended loans to non-bank financial intermediaries during the financial crisis. When the US economy entered COVID-induced lockdowns earlier this year, the Fed reopened some of these facilities and extended them, providing liquidity, for instance, to bond dealers. The Fed requires collateral for such emergency measures, which need to be investment grade. The Fed will thus only provide liquidity, but will not assume significant amount of risk. It will also not flat out bail out banks. These measures are only short-term loans intended to keep financial markets liquid. Third, during the 2008 financial crisis, with support from the outgoing Bush administration, Congress passed the Emergency Economic Stabilization Act, also known as the financial bailout. This is an instance of the executive and the legislative branch lending to banks directly. The associated program is known as the Troubled Asset Relief Program, or TARP. The legislation at that particular point in time offered up to about $800 billion to distressed banks as loans. These loans, in contrast to the Fed, assumed significant risk. And also, just to be clear for a little bit of history, the measure was separate from the Obama administration stimulus bill the following year. In 2020 to date, no systematic bailout of the financial system is in place under the CARES Act, in part because financial intermediaries do not need it at this point. However, some borrowers, especially corporate bonds markets, have received some funding secured by congressional funds. COVID, as we will discuss, is not a financial crisis like the last recession was for this reason. Arguably, the bailout sounds expensive. Wall Street bailouts are unpopular literally across the aisles. And however, much of these funds were paid back, except for about $100 billion, which amounts to less than 1% of GDP. Recapitalizing General Motors and Chrysler, which received TARP funding, and AIG, which was assumed by the government directly for a period of time, was actually more expensive. Still, TARP was not the only cost associated with the bailout. The GSEs needed to be recapitalized under existing guarantees for a price tag of roughly $200 billion. Tax revenue was also lost due to the onsetting recession, and the government essentially signaled to much of the financial industry its willingness to bail out the sector as needed. However, the episode also triggered a large set of new regulations in exchange. Finally, the International Monetary Fund, the IMF, has at times assisted smaller countries like Iceland or emerging markets with assistance in the context of financial sector crises, when they themselves could not lift the burden to bail out their financial sector. There are limits to this approach. For one, the IMF is not a central bank. It does not have monetary authority, meaning that it needs to raise contributions from member countries to generate loans in the first place. Second, voting rights at the IMF are proportional to fund contributions. The largest contributor is the United States, and US interests have had an influence on lender decisions with the IMF, which has seen its share of controversies in the emerging market crisis of the 1990s, for instance in Mexico, or the early 2000s in Argentina.